Before this video begins, I want to give a quick shout out to a subscriber who suggested this topic in the comments. You know who you are, and honestly, when I first read your comment, I thought it would make for a decent video. Turns out, it became one of the most fascinating rabbit holes I've ever gone down, so thank you for that. Now let me give you two numbers. The United States national debt stands at approximately $36 trillion as of March 2026. That number dominates every cable news segment, every political debate, every dinner table argument about the future of this country. 36 trillion. It sounds terrifying. It's designed to. But here's a number you've almost certainly never heard anyone say out loud. Total U.S. private non-financial sector debt also sits at approximately $36 trillion. Households, businesses, the entire non-government economy, roughly the same figure. One of these numbers dominates every headline. The other one caused every major financial crisis of the last 100 years. The 1929 crash, the 2008 collapse. Both detonated by private debt, not government borrowing. And the question nobody seems to be asking is why we've been staring at the wrong scoreboard this entire time. There's a period in recent American history where the government did exactly what deficit hawks demand. Balance the budget. Ran surpluses. What followed will reframe everything you think you know about responsible fiscal policy. But first, you need to understand the accounting. And every dollar of that national debt everyone argues about, it's also something else entirely. Something that, once you see it, makes the entire debate look upside down. I'm Alex. I read Federal Reserve reports, central bank policy papers, and economic history so you don't have to. And I'll be honest with you, this topic broke my brain a little, because it forced me to unlearn something I thought I understood about how money actually works in a modern economy. If you find this kind of deep dive valuable, make sure to hit that subscribe button and give this video a thumbs up, because this channel only grows when you share it. Before we get into this, I want to know something. Do you think the national debt is the biggest threat to the US economy, or do you think it's something else entirely? Drop your answer in the comments, because by the end of this video, you might change your mind. Here's the thesis. Two economists, Steve Keen, formerly at the University of Western Sydney and now at Kingston University London, and Richard Murphy, professor of accounting at Sheffield University Management School, have been arguing for years that the national debt obsession is not just misguided, it's dangerous. And the reason it's dangerous is mathematical. Every single dollar of government deficit spending becomes a dollar of net financial assets in the private sector. That's not ideology. That's not left versus right politics. That's double entry bookkeeping. Which means the very act of eliminating the deficit, the thing every responsible politician tells you they want to do, forces the private sector into financial deficit. And historically, when that happens, economies don't just slow down, they shatter. Now I know what you're thinking. That sounds completely backwards. How can government debt possibly be a good thing? Doesn't that just burden future generations? That's exactly the reaction the system is designed to produce. You've been trained, from childhood, from every news segment, from every politician's stump speech, to think of the national debt like a household credit card bill. You spend too much, you go broke. Simple. Intuitive. And that's exactly the problem, because it's a metaphor that doesn't survive contact with how the system actually works. Not for a government that issues its own sovereign currency. And the reason this distinction matters is not abstract. Confusing these two things, treating the federal budget like your family budget, has directly led to policy decisions that have reliably preceded the worst financial disasters in modern history. The people who made those decisions thought they were being responsible. That's what makes this so dangerous. Let me show you the accounting. Because once you see the ledger, you can't unsee it. And once you can't unsee it, the entire national debt debate starts to look like an argument about the wrong patient while the real one bleeds out in the next room. Think of the economy as a closed system with two main sectors. The government sector and the private sector, which is you, me, businesses, pension funds, everyone who isn't the federal government. In this system, every financial transaction has two sides. If I pay you $10, I'm down 10, you're up 10. The net across the whole system is always zero. This is what accountants call double entry bookkeeping. It's not a theory. It's not a model you can agree or disagree with. It's an identity. It's true by definition, the way 2 + 2 = 4 is true by definition. So when the government spends more than it collects in taxes, which we call a deficit, Where does that extra money go? It doesn't vanish. It doesn't pile up in some imaginary government closet. It goes into the private sector, your bank account, your employer's revenue, the bonds in your retirement fund. Every dollar of government deficit is a dollar of private sector surplus. Richard Murphy has written extensively about this on his Tax Research UK blog and in his book, The Joy of Tax. He calls it the most important equation in economics that nobody talks about. The government's red ink is literally the private sector's black ink. They're the same entry on opposite sides of the same ledger. And every dollar of national debt represents a dollar of net financial wealth held somewhere in the non-government economy. Let that settle for a moment. Because it means that $36 trillion national debt you keep hearing about, that's also $36 trillion of financial assets held by the private sector. Bonds, savings, wealth. The debt and the assets are the same thing, viewed from opposite sides of the ledger. So if that's true, and the accounting says it is, then what happens when you do the reverse? What happens when the government balances its budget or runs a surplus? The private sector loses that inflow. It's forced to fund its own spending, its own investment, its own consumption through borrowing, through private debt. And that brings us to the number that should actually keep you up at night. Now that you see the ledger, I need to show you what happens when private debt fills the space that government spending leaves behind. This isn't abstract theory anymore. This is history. And this is where real people lost real homes, real businesses, real lives. The 1920s, the roaring decade. Stock prices soaring, real estate booming. America intoxicated by its own prosperity. Jazz in the speakeasies. Fortunes built overnight. It felt like the good times would never end. But underneath the party, something structural was happening that almost nobody noticed. Total private credit was expanding aggressively throughout the decade. Margin lending for stock speculation exploded. A shoeshine boy could borrow money to buy shares in Radio Corporation of America. Households and businesses were leveraging at rates that dwarfed anything the economy had seen before. And here's the part that doesn't make it into most history books. The federal government was actually running budget surpluses for most of that decade. The government was doing the supposedly responsible thing, pulling money out of the private sector through taxation. So the private sector, starved of government, created financial assets, replaced them with debt. It was building a house on sand and calling it bedrock. When the bubble burst in 1929, the mechanism that destroyed the economy wasn't government profligacy. It was the collapse of private debt. Borrowers couldn't repay. Banks failed in waves, over 9,000 of them by 1933. Credit evaporated, spending collapsed, unemployment hit 25%. Economist Irving Fisher, who had himself been nearly wiped out by the crash, documented this mechanism in his landmark 1933 paper in Econometrica, calling it debt deflation. His argument was elegant and devastating. When the private sector over-leverages and then tries to pay down its debts all at once, the very act of repayment destroys the money supply, drives down prices, and makes the remaining debt even harder to service. It's a death spiral. And it starts in the private sector, not the public one. Now, there's a name for the mechanism that turns stability itself into the engine of the next crisis. We'll get there. But first, I need to show you that 1929 wasn't a one-time historical accident. Because if it were, you could dismiss it. You could call it a fluke. But here's the problem. The same pattern repeated, almost beat for beat. The 2008 financial crisis. The Financial Crisis Inquiry Commission, established by the US government and chaired by Phil Angelides, published its final report in 2011 after interviewing over 700 witnesses and reviewing millions of pages of documents. Their conclusion was unambiguous. The central cause of the Great Recession was the collapse of the US mortgage debt bubble, not federal borrowing, not the national debt, not government overspending, private mortgage debt. At its peak, American household mortgage debt exceeded $13 trillion. That's $13 trillion of promises made by private citizens to private banks, not a single cent of which showed up on the national debt clock. Households had been encouraged, incentivized, and in many cases, actively deceived into taking on mortgages they had no realistic ability to repay. The financial industry packaged these debts into complex securities, stamped them with AAA ratings, sold them to pension funds and foreign governments, and when borrowers defaulted, the entire global financial system seized up like an engine running without oil. Steve Keen was one of the very few economists who predicted this crisis. Not because he had a crystal ball, but because he was watching the right number. While mainstream economists were running models that literally didn't include banks or private debt, which sounds insane but is true, Keen was tracking the rate of change of private credit. He argued in his 2001 book, Debunking Economics, later revised in 2011, that the economics profession had made a catastrophic error by ignoring private credit creation entirely. Banks don't just move existing money around like shuffling cards. They create brand new money when they make loans. And when private debt grows faster than the economy's ability to service it, you're not building wealth. You're building a bomb with a delayed fuse. So 1929 and 2008 are the same pattern. Private debt boom, fueled by optimism, enabled by deregulation, followed by spectacular collapse. But there's an economist who didn't just describe what happened. He explained why these aren't accidents, they're features, structural features of how capitalism actually works, and his theory explains something that should make the hair on the back of your neck stand up. The calmest, most prosperous economic periods are actually the most dangerous. His name was Hyman Minsky. Minsky published Stabilizing an Unstable Economy in 1986, and his core insight is one of those ideas that, once you hear it, permanently changes how you see the world. He called it the financial instability hypothesis, and it goes like this. During periods of prolonged economic stability and growth, something predictable happens to the psychology of both borrowers and lenders. When times are good, when businesses are profitable, when asset prices keep rising, when nobody you know has lost money in years, people become more confident. They take on more risk. Lenders relax their standards because their loan books look pristine. Borrowers stretch further because everything they've borrowed for has gone up in value. And the debt structures in the economy evolve through three distinct stages. First, hedge financing. This is the safe kind. Borrowers can comfortably cover both principal and interest payments from their regular income. Conservative, boring, sustainable. Then, speculative financing. Now borrowers can cover the interest payments, but they need to refinance or roll over the principal when it comes due. They're betting that credit markets stay open and favorable. One step further out on the ledge. And finally, what Minsky called Ponzi financing. Not a Ponzi scheme necessarily, but the same structural logic. Borrowers can't cover either principal or interest from their income. They are entirely dependent on the asset they bought continuing to rise in price. They're not investing. They're not even speculating in any rational sense. They're gambling that the number only goes up, because if it doesn't, they're immediately underwater. Think about that for a second. How many people bought homes in 2005 and 2006 with interest-only adjustable rate mortgages, betting they could refinance or flip the property before the rate adjusted? That's textbook Ponzi financing. It wasn't stupidity, it was the system working exactly as Minsky predicted it would. And here's his devastating insight. The transition from hedge to speculative to Ponzi isn't caused by some external shock. It isn't caused by bad regulation or corrupt bankers, though those help it along. It's caused by the stability itself. The longer things are calm, the more confident everyone becomes, the more leverage the system accepts as normal, and the more structurally fragile everything gets beneath the surface. Stability breeds instability. The calm is the storm's engine. The good times write the check that the bad times cash. Sound familiar? It should. Because as of the third quarter of 2025, U.S. household debt stands at approximately $18 trillion according to the Federal Reserve's Z1 financial accounts. Total non-financial private sector debt exceeds $36 trillion. The Bank for International Settlements, which tracks this data globally, confirms that private credit expansion in advanced economies consistently precedes financial crises. We're not in uncharted territory, we're in very well-charted territory. We just keep refusing to read the chart. Now, I'm not making a prediction. I want to be clear about that. But I am pointing at a pattern that is repeated with mechanical precision. Everything I've shown you so far is about what happens when private debt explodes. 1929, 2008, the accounting identity. Minsky's explanation for why it keeps happening. But here's the part that should genuinely unsettle you. Because this is where the logic completes itself in a way that turns conventional wisdom completely on its head. There was a time the US government did exactly what every responsible politician, every fiscal hawk, every balanced budget amendment supporter says we should do today. They balanced the budget. They ran surpluses. and the aftermath nearly broke the economy. Between 1998 and 2001, the Clinton administration achieved something celebrated by both parties: federal budget surpluses. 4 consecutive years where the government took in more than it spent. Headlines cheered, pundits applauded. The national debt clock in Manhattan actually started running backwards. It was treated as an unqualified triumph of fiscal discipline, proof that America could be responsible. But remember the accounting identity. It doesn't take holidays. It doesn't care about politics. If the government runs a surplus, it is by definition pulling more money out of the private sector in taxes than it is putting in through spending. The private sector's financial balance must flip to deficit. There's no escape from this arithmetic, and that's exactly what happened. During the Clinton surplus years, the US private sector went into financial deficit for the first time since the late 1920s. Let that land. The last time the private sector had been in that position was right before the Great Depression. Households and businesses were spending more than they earned. The only way to sustain that without government financial support flowing in is through borrowing, through private debt, through exactly the mechanism that Fisher described, that Minsky formalized, and that history had already demonstrated was a loaded weapon. And what happened next? The dot-com bubble inflated to absurd proportions, fueled by private credit and speculation, and burst. The economy entered recession in 2001. The surplus vanished overnight as tax revenues collapsed and spending automatically increased. The pattern held. Again. Steve Keen has pointed to this period repeatedly in his 2017 book, Can We Avoid Another Financial Crisis?, as evidence that government surpluses don't eliminate financial risk. They transfer it. They move the debt burden from the public sector, which issues its own currency and can never involuntarily default on debts denominated in that currency, to the private sector, which absolutely can default, and does, catastrophically. The US Treasury's own historical tables confirm this. Federal surpluses have occurred only a handful of times since 1900, and they have reliably preceded economic downturns. Not because surpluses magically cause recessions, but because they force the private sector into exactly the borrowing position that Minsky warned about. The medicine everyone prescribes is the poison. I know that's a hard truth. The idea that balancing the government's budget could be the dangerous move sounds almost absurd. It violates everything you've been taught since grade school, but the accounting doesn't lie, and the history doesn't lie, and the two agree with each other perfectly. So let me tie all of this together, because when you see how these pieces connect, the picture becomes impossible to ignore. The accounting identity tells you that government deficits create private surpluses. That's the mechanism. It's not theory, it's arithmetic. 1929 tells you that when private debt replaces government spending as the engine of economic activity, the system becomes fatally fragile. That's the historical proof. 2008 tells you it wasn't a one-time event. It's a structural pattern embedded in how modern economies function. The same dynamic, the same progression, 80 years apart. Minsky tells you why it keeps happening. Stability itself generates the overconfidence and leverage that make the next crisis inevitable. It's not a bug in the system, it's a feature of the system. The machine is working as designed. And the Clinton surplus period tells you the most disturbing part of all. The thing everyone says we should do, the balanced budget, the fiscal responsibility, the surplus, is precisely the policy that forces the private sector into the debt spiral that precedes collapse. The popular remedy is the disease. Remember those two $36 trillion figures I opened with? The national debt and the private debt? Now you understand they aren't two separate problems. They're the same ledger. They're connected by an accounting identity that cannot be argued with, cannot be legislated away, cannot be broken by political will. When one shrinks, the other must grow. That's not opinion. That's the mathematics of double-entry accounting applied to the entire economy. The national debt everyone argues about isn't a bomb. It's the counterweight. It's the net financial assets sitting in your bank account, your pension fund, your savings bonds, your money market fund. Remove it, and the real $36 trillion, the private debt, has nothing holding it up. No surplus to cushion it. No government-created assets to service it against. Just borrowers owing money to lenders with no net financial cushion in between. This isn't prediction, it's pattern recognition. It's reading the balance sheet that actually matters instead of the one that gets the most cable news airtime. And once you see it, you can never go back to watching the wrong number and feeling afraid of the wrong thing. Your future self. The one making financial decisions in a world of competing narratives, political noise, and 30-second sound bites about debt clocks is counting on you to understand which ledger to watch. Not the one on cable news, not the one politicians wave around during election season, the one in the Federal Reserve's Z1 report, the one tracking household debt, corporate debt, the rate of change of private credit. That's the real dashboard. That's always been the real dashboard. And now you know how to read it. I want to hear from you. What's a topic in economics or finance that you feel like nobody's explaining honestly? What do you want me to dig into next? Drop it in the comments, because the last time someone did that, it turned into this video, and I think it might be one of the most important ones I've made. I'll see you in the next one.